If you are trying to buy a home in Ireland in 2026 and something feels off about your mortgage approval, you are not imagining it. Because right now, people with good jobs, stable income, and even strong savings are getting rejected by banks. And they are not told why. Just a simple message. Application not approved. Or you qualify for less than expected. So what is really happening in Ireland's mortgage system? Is it the banks, the rules, or something most people are missing completely? Today, we break it down clearly. No jargon, no confusion, just the real reasons approvals are failing in 2026 and what you can do about it. Let's start with a real situation. A couple from Galway, both working full-time jobs, with a combined income of just under €100,000. Strong savings. No obvious debt issues. On paper, everything looked perfect. They found a home they loved and applied for a mortgage. Then came the result. Rejected. Not once, but again and again, with no clear explanation. From the outside, everything looked fine. But inside the system, something very different was happening. In 2026, mortgage approval is no longer just about income. Banks are asking a deeper question. Can this person survive financial pressure in the future? Not just today, but years ahead. Even small financial behaviors that were once ignored are now being flagged. Overdrafts, credit usage, buy now pay later, small loan activity, everything matters. Behind every mortgage decision in Ireland, there is a system. The Central Bank Mortgage Rules. These rules were introduced in 2015 to protect financial stability and prevent housing bubbles. They work using two limits, loan-to-income and loan-to-value. Loan-to-income controls how much you can borrow based on salary. First-time buyers can usually borrow up to 4 times their income. Second-time buyers up to 3.5 times. So even with strong income, there is a strict ceiling. Loan-to-value controls your deposit. Most buyers need at least 10%. So for a €400,000 home, you need at least €40,000 saved before fees. In 2026, this feels even stricter because house prices have increased, but lending limits have not kept up. Now back to the Galway couple. They thought income was enough. But the bank saw something else. Not one major issue, but patterns. Overdraft usage, credit card balances near limits, buy now pay later activity. Individually small, but together they signal risk. Banks don't judge isolated actions. They judge behavior patterns. In Ireland, all lending activity is recorded in the Central Credit Register. This includes loans over €500 such as mortgages, credit cards, car loans, and personal loans. But here is what most people don't realize. There is no credit score. Instead, banks see a full financial history report. Repayments, loans, missed payments, and every credit application. Even applying for too much credit in a short time can make someone look financially stressed, even if the credit was never used. But credit history is only part of the picture. The real story is in your bank statements. 6 months of transactions, checked manually by lenders. They look at your real behavior. Do you save regularly? Do you manage expenses well? Do you rely on overdrafts? Because banks are not just asking how much you earn. They are asking if they can trust how you manage money every month. Living costs have also changed everything. Rent, food, transport, bills, all increased. So even strong salaries don't automatically mean strong borrowing power. Banks calculate what is left after all expenses, not just income. Many people believe that saving a bigger deposit guarantees approval. But that is not true. A deposit helps, but it does not fix credit behavior, income stability, or spending patterns. Even with strong savings, approval can still fail if financial behavior looks risky. Banks then apply stress tests. They ask, if interest rates increase, can this borrower still manage repayments? So approval is not based on current comfort, but future risk. Some applications fail without warning. Reasons can include irregular income, cash deposits without explanation, gambling activity, sudden financial changes, or switching banks close to application. To banks, consistency means safety. Inconsistency means risk. So the reality in 2026 is simple. Mortgage approval in Ireland is no longer just about income. It is about financial behavior, stability, and trust. And those who understand this early are often the ones who avoid rejection cycles and move through the process with less stress. But getting mortgage approval is only part of the journey. Because even buyers who receive approval can face challenges they never expected. Let's look at some of the important things many home buyers overlook after they receive mortgage approval. Many buyers focus heavily on saving a deposit. But the deposit is only one part of the total cost. Buying a property can involve solicitor fees, valuation fees, home insurance, moving expenses, and in some cases repairs or upgrades shortly after moving in. For many first-time buyers, these costs come as a surprise. The strongest buyers build a financial buffer for unexpected expenses because home ownership often brings costs that cannot always be predicted. Many people assume that once they are approved for a mortgage, they can buy any property they choose. But that is not always the case. Lenders also assess the property itself. Issues such as structural concerns, planning permission problems, legal complications, or properties requiring extensive renovation can sometimes delay or complicate the mortgage process. This is one reason surveys and professional inspections are so important. Identifying problems early can save both time and money. Another factor smart buyers consider is the future. Mortgage repayments today may not always be the same in the years ahead. Interest rates can change. Living costs can change. Personal circumstances can change. The most successful buyers think beyond approval and ask themselves an important question. If my monthly costs increase in the future, will I still feel comfortable managing my mortgage? Planning ahead creates greater financial security and reduces future pressure. The Irish mortgage market has changed significantly over the past decade. Getting approved today requires more preparation, more planning, and a better understanding of how lenders assess risk. But for buyers who take the time to understand the process, prepare properly, and make informed decisions, home ownership remains achievable. The journey may be more challenging than it once was. But knowledge, preparation, and patience remain some of the most valuable tools any buyer can have. And the more informed you are before applying, the stronger your position will be when the right home finally comes along. Subscribe for more insights on mortgages, housing, and life in Ireland. Before you go, our next video is about Ireland house prices by county, 2026, where you can actually afford to buy. We'll break down the most expensive areas, the more affordable counties, and where first-time buyers still have a real chance in today's market. Thank you for watching. And stay tuned, this video will help you understand where you can actually afford to buy in Ireland.